talk about. We'll discuss everything kind of leading up to the events that we've had and get all caught up for the day. So, the big talk today was mainly amongst the Fed and leading up to the Fed's meeting today, which they left interest rates exactly where they were. Trump was starting off the day back to trolling, saying that I wonder if I'm allowed to appoint myself as the Fed, and went on to say that he think he'd do a better job than Powell, who, remember, this guy appointed Jerome Powell back in 2018. So it's just ironic this is the scenario that is being played out right now. And he's saying that he should cut rates, although we already knew leading up to this event that they weren't going to cut rates. The committee decided to maintain the target range for the federal funds rate at 4.25 to 4.5%. Remember, it's in a range. And aside the interest rate decision, everybody was kind of waiting on that Q&A session during the press conference, and also for the Fed to release what is called the SEP, the Summary of Economic Projections, which contain the dot plot, just to get more insight as to whether the Fed is deciding to cut more or kind of exactly what the market was expecting the Fed to do for 2025 as far as how many rate cuts we'd get. And the likely scenario that we expected were that, hey, they're going to leave the rates the same, and that we're expecting 2 cuts from the Fed this year. And yeah, the Fed left rates the same. They said the economy was pretty solid in 10 members. So here's the summary of economic projections, and you scroll through here, we'll get the dot plot. And what we see is that 10 members expect at least 2 rate cuts this year for 2025 from where we're at right now. And the economic projections show that a rise from the last forecast in both inflation and unemployment being a concern. So where's that at? I might have lost my place. Yeah, it's right here. So they're expecting GDP to come in a little bit weaker than they projected back in March. They're expecting the unemployment rate to rise a little bit than they expected in March. They're expecting PCE to rise for 2025 and core PCE to really rise. And remember, that's the number they're watching. Core PCE strips out the volatile segments such as food and energy, which go up and down a lot. So they believe that a more secure measure of measuring inflation as far as for the consumer goes towards cutting out those volatile prices. Now, the expectation of the rise of both inflation and unemployment is alarming because what that points towards is stagflation, and stagflation is really the most undesirable scenario to play out just because of what it does. So what it does is it puts the Fed into this weird position, this weird place, because they're fighting inflation, but what if they have to change their focus on the fight on inflation to kind of more so focus on the labor market? And the way you do that would be by lowering rates, which is kind of contradictory. It's a contradiction to their fight on inflation they have right now, trying to get it to come down to their 2% target for core PCE. But in order to help the labor market and keep employment steady and keep the economy rolling along, they'd have to cut rates, and cutting rates stimulates the economy and is a force on inflation. So it could set them back. And this comes right as there are these articles coming out about the Fed leaving rates, cutting rates and causing a layoff to happen. So there's these layoffs that are, wait, I completely lost my train of thought. So people are expecting the unemployment rate to start rising from tailwinds from both interest rates being high a while, tariff impacts, and then companies just hoarding labor from back during the pandemic, and now they got too many workers. And that's what this article right here, the biggest companies across America are cutting their workforces by, Chip Cutter and Lauren Weber. And what this article is really talking about are, hey, there's these large companies that, there's a growing belief that having too many employees will slow a company down, and that anyone still on the payroll could be working harder. And what this article dives into is the use of AI what does AI allow people to do? Be more productive at work. So in this case, less people can do more. And that leads into this job market where we're seeing companies not necessarily lay off a ton, but they're starting to begin laying off. This AI trend may take a bit longer to kick in, but AI is growing and the use of that, and people aren't getting hired as much. So if you're looking for a job right now, like there's not a lot of openings. Like businesses are just kind of sitting with the workforce that they currently have. And where the danger comes regarding that is that like maybe we do got too many employees, and like companies like Amazon and some of the others mentioned Procter and Gamble, Match Group, Estee Lauder. There's some large companies refiguring whether or not they should hold on to being overstaffed and then just like laying off some of them and allowing the staff that they do keep do more duties with AI. And this was brought up during today's press conference. They asked Jerome Powell, how will AI affect the labor market? Because the Fed is known to react too late to problems that arise in the economy. And the main question is that, hey, these interest rates are pretty high. Could that lead to unemployment? And while we're headed towards this direction of unemployment, how's that impacted by AI, which even further impacts unemployment? Will AI really be augmenting labor or replacing labor? I wouldn't overreact to a couple of data points, he said, alluding to recent comments from CEOs, most notably Amazon, that AI could lead to workforce reductions at the company. And what Powell said is that AI should instead create jobs at the same time and has transformational potential. He noted that these are still early stages of AI. What we see now will be very different in 2 years. So it could start moving, and it could be a much longer term before AI ultimately starts impacting the labor force to a much more noticeable extent. But that is something to consider. Optimists feel it will make everyone much more productive, Powell said, but before adding that, skeptics are worried AI will create a wide swath of job losses, both white collar and blue collar workers. So don't expect the Fed to be factoring in AI's impact on the labor market and its unemployment forecasts anytime soon. So mainly what we got from the Fed today is that, hey, we're still good waiting and seeing what happens. And until then, we're just going to keep on watching the dust settle, and then we'll go from there once we have more clarity on data. And we still think that the odds of them cutting rates in September is still on, so we're still thinking that is when we're going to get one of our possible 2 cuts this year. Who knows if we get 2 or not? All that's up in the air, but what we do see is that the odds of the Fed keeping rates the same at the next meeting in July, 41 days away from today, 90% odds or prediction rate that they keep rates steady there. And then if we look at September 17th meeting, this actually surged a bit. So we're up over 60% as far as cutting rates. A 1/4% is what the Fed's expected to do at their September 17th meeting. Now, what they're really watching are the impacts on tariffs, trade deals, and how the macro economy is going to react towards the current situation. On top of that, the Iran and Israel Middle Eastern conflict that's going on and how that impacts inflation overall. So it doesn't really seem like things are calming down regarding that conflict. If anything, I'd say that it's getting more heated up, so to say. So regarding the attacks keep on going, and the US is getting more involved rather than less. And Trump's made a lot of commentary just as the days fly by on this. Today he was asked if he'd strike Iran, and his response was funny. He was like, I may do it, I may not. It just kind of depends on them. We'll see what I do. And that doesn't give a whole lot of certainty, right? And Americans are being evacuated from Iran. There's it looks like the death toll hasn't changed too much. Israel hit Iran's largest enrichment facility, and that was underground. And pretty much where we're at is, hey, I don't want just a ceasefire. I want a complete victory regarding this conflict going on. I don't want Iran to have nukes. And that's that. But let's remember, so if he's really certain on complete victory, I want them to stop, I want them to surrender. I don't want them having any nuclear weapons. And if they don't stop, how far do you got to go when you're in Trump's position to get them to stop and do exactly what it is you want for them to fulfill on their side of your order? Now, that's very questionable because that may or may not involve more and more and more of the US involvement regarding this. And that is why the idea of a strike on Iran from the US is coming up so much lately. Now, we got to remember that Iran is a big supplier for oil to China, a big one, and China gets cheap oil from Iran. So let's just think about a situation where the US is getting more involved, and then that's kind of messing it up from China's perspective because now their cheap oil isn't so cheap, or it's getting held up because of the troubles going on, and then it starts not looking very well. So that's just something to consider. If China picked Iran's side and the US is on Israel's side, that could grow into a much larger war and possibly even a World War III situation. Not to spread a whole bunch of FUD, fear, uncertainty, and doubt out there, but that's just something to consider, and people are watching that for a lot of reasons that could be very impactful. Now, back to the Fed and why the war impacts them and their decisions. It's because of oil prices and how they're surging due to this conflict. So there's this really important strait. I don't remember if it's Strait of Hormuz or Strait of Hormuz, maybe Strait of Hormuz. But if that gets halted, that is huge for petroleum trade, global oil trade going on. And that would be one factor leading towards inflation if there's this big holdup in global oil trade and it's just not able to get shipped because of the ongoing war and, just freezing the entire supply chain. So this wouldn't necessarily be a great thing. Now, that's not a problem now, but that is something to consider assuming it gets worse. So what we're looking at are two likely scenarios right now, and we don't know which one we're going to get, but either this conflict is resolved, we'll see oil prices start trending down again, stocks go up because the idea of inflation is going down if oil prices are going down. At least inflation related to this. There's still inflation regarding a lot of other things, a lot of other factors, but inflation regarding oil would go down because the conflict solved, no shocks in supply chains, stocks are at least happy about that, and maybe all-time highs are around the horizon. Now, the other situation is the US gets more involved, maybe China gets more involved, and maybe one of the two groups starts actively attacking. Right now, the US is involved just by kind of trying to mediate the situation. Hey, let's get a deal done. I don't want this. I'm making it really clear. We're going to defend this side, but we're not necessarily attacking, although they are making notes of, hey, we could attack depending on them. But we don't know that, remember. So that would be the complete opposite. We could see oil continue to surge up. The idea of inflation expectations increasing due to this Middle Eastern conflict, and that wouldn't really be good for stocks in the eyes of the Fed when you're looking at it through the eyes of the impact of the Fed, because that even in the face of rising unemployment, inflation would be rising even more on top of the tariffs and stuff and trade deals and deficit spending, some of these other forms of inflation, and the Fed's job could be completely different. It would think about the idea of the Fed having to, instead of just holding rates steady and not cutting at all, imagine them talking about hiking rates and raising rates again. That would be something completely different. So yeah, oil is a force of inflation. Then other forms of inflation to watch out for would be the tariff impacts, deficit spendings, and then think about when people are expecting inflation to happen, companies give them that, like, hey, y'all were guessing it anyways, I kind of need to raise my costs and y'all are already expecting it, let's just go ahead and raise rates. And then on top of that, credit card companies are raising their annual fees way up, insurance costs are going up, and then financing costs are still high due to interest rates. So there is a lot of uncertainty there, and we don't know what's really going to happen. Now let's look at stocks for today. I'm going to pull up for the NASDAQ 100, and then I am gonna pull up Bitcoin just to kind of, actually, let's put it on 4 charts real quick. So we got Bitcoin, this one is BTC USD, and then let's also have XAU USD up, and then maybe let's just have the VIX, what the heck, and let's talk about this stuff. So maybe on the 15-minute chart, so we could just get an idea of what the trend has been the last few days. All right, zoom out a little bit for gold, and I'll zoom out a little bit for Bitcoin, just so it's a little bit more clear. Oh wow, we jumped off that line, 109. Didn't even slightly, I didn't really touch it. All right, make sure y'all could see this. All right, cool, y'all could see it. So with the Fed being the main idea today for everybody to watch, there's usually a lot of volatility, and the Fed is known for really tanking stocks. But usually what happens the few days after the Fed announces rate decisions and they impact the markets is usually the next day, and the next few days are usually positive, and at least the last 10 meetings, that's what's shown. Now today's stocks ended out a little bit lower than they started. Bitcoin's a little lower. We're starting to see gold really reignite a little bit after really being stuck in this channel, this consolidation movement right here, this pattern it's been in the last few days. It looks like gold could have probably bottomed out, and the idea of this US getting more involved in this Israel Middle Eastern stuff going on is kind of scary, and they're diversifying away from stocks. And I mean, talking about diversifying out of stocks, there was this global survey from eToro that came out, and what it was really talking about is how there's a lot of uncertainty out there. The US dollar is getting a little bit weaker, and that there's some other stuff it went through. So really what it's talked about is gold and Bitcoin being popular picks among retail investors, with 58% of retail investors recently buying or planning on buying around those two groups, those two asset classes. And that's according to this survey, and they surveyed 10,000 self-directed investors across 12 countries, 1,000 of which were U.S. Citizens. And it also revealed that 25% of them were rotating out of these U.S. stocks. And that's just interesting, because it's still like sell America, buy other stuff. So people are still looking out for other assets to buy, whether that's gold, whether that's, I mean, I guess you could kind of argue Bitcoin according to this survey, but Bitcoin's really been in a slump. I mean, if you look at these two charts, though, they look the same. Both these same little consolidation patterns, although it looks like Bitcoin kind of happened. So gold moved a little bit slower. So it's like the 13th, 15th is where gold topped out, and we're just now starting to go up. Bitcoin's happened on the 16th, so it's like a day lag. But I mean, overall, the charts kind of look similar. But back to this survey, people are buying other stuff, whether it's gold, whether it's Bitcoin, whether it's international stocks and international bonds. Now, I thought it would be interesting just because I don't remember what it was called, but there's this one for market cap of asset. I don't remember what this website was called. Oh yeah, 8 market cap. And what we see is the market cap for gold was, or is, 22.807 trillion. And I think this is why this is popular. This is relevant to this survey we was just looking at, because people are wondering why people are buying both gold and Bitcoin. Like gold's got 500 years of history of how it performs, but Bitcoin's a lot newer and it's a lot smaller. It's less than 10% of gold's market cap. So gold is 22.8 trillion, let's just call it 23 trillion. Bitcoin is still, we'll round down for Bitcoin, 2 trillion in size. So a lot of people are thinking that Bitcoin has a lot more room to run versus gold. At least I don't know this. I don't know this, but just kind of thinking outside the box, like them young whippersnappers, them Gen Z, them millennials buying up Bitcoin, their little Bitcoin, their digital gold, rather than buying the real gold. So that's just kind of what I was thinking reading this global survey. Now, we did get some data today that I wanted to talk about. The Fed released their economic summary projections. We didn't get the rate cut, although we didn't really expect the rate cut to happen in the first place. Hey, what's up, Andrew? Thanks for checking out the video. Hey, I didn't know people actually watch these. That makes me happy seeing that. Now, regarding the Middle East, we see that that's still possibly escalating from where it's at, and then we've seen how stocks reacted to all of the mess we got. Now, we also got some data I wanted to look at together. So we got jobless claims from the Department of Labor. And what we see is that for the week of June 9th through the 14th, we've seen jobless claims fell for the first time in a month, falling by about 5,000 to this 245,000 figure. The previous week's level was revised up by 2,000 from 248 to 250, yada, 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 blah, blah, blah. Claims usually rise during the summer, and think of seasonal jobs and some of the seasonal jobs. So that'll be like school workers who are out during the summer. So what happens is it's hard to gauge whether this data is impacted by the tariffs or new to the channel, literally got recommended this video on my nighttime walk. Hey, I get the walks in too. Appreciate you. Thanks for stopping by. But what happens is these people are out of the workforce for the summer, and they might apply for benefits during that time. So while there are higher claims in the summer, it's hard to gauge whether this is impacted by any of this other stuff going on, or is this just like the regular seasonal stuff. Now, the unemployment rate was 1.3% for the week ending in June 7th, changed from the previous week. The advanced number for seasonally adjusted insured unemployment during the week of June 7th was 1.945 million, a decrease of 6,000 from the previous week's revised level. The 4-week moving average was 1.926 million, an increase of 13,000 from the previous week's revised average. This is the highest level of the average since November 20 of 2021. Gosh. Now, speaking of unemployment, like it seems to be doing pretty well. People aren't like there's not blood in the streets, so to say. And people are actually doing well as far as millionaires too. So this is from UBS. They did a report on wealth for it's for 2025. They got some 2024 data in there that I'm going to talk about. So the millionaires expanded in 2024 by 680,000 people. So it's up 1.2% in 2024, with the US adding 379,000 new millionaires. That's more than 1,000 a day, while the number of billionaires grew to 2,891 globally. Most of the millionaires live in the US. Just looking at my notes, there are about 24 million millionaires who live in the US, and that's the largest number. And yeah, all right, that's pretty much what I had for the UBS. Checking to make sure nobody else commented. Appreciate y'all commenting and showing some love on the videos. We also got some real estate data out today, and just kind of to sum up how everything's going, the real estate market is, in a kind of slump lately, and it's really been due to this 30-year fixed rate mortgage. So I'm here in Oklahoma, so locally I could say that mortgage rates are around 7% still. They've dropped a little bit, but that's still not enough to get people to move and transact. Like, people still got lower interest rates, which causes this lock-in effect. Like, why would I sell my house, buy something that's more expensive because home prices are still elevated and continue to be elevated, and I'd have to get a higher interest rate? Like, they could sell their same home, buy it back, and the payment will be more. So that's causing a lot of sellers to wait. And a lot of sellers are buyers. When you think about it, they'll sell a home, buy a home, and then buyers are kind of sitting on the table like, man, I might as well just rent right now. If I don't have a low interest rate mortgage, it'll be a little cheaper. I'm just going to kind of wait. So that's really dampening the demand for that. And inventory is starting to build around the country, leading to lower sentiment in the industry. And the real estate industry impacts so many different industries. Here, what say? SCP shows projections of inflation higher, GDP lower, labor neutral higher for longer. I felt Powell was kind of dovish during his press, but really fearful about tariff uncertainty. Recipe for stagflation. Exactly. And they're expecting higher inflation and higher unemployment due to all of these different factors going on, and that puts them in this tough spot. And then back to the real estate market with lower demand and people not transacting. Think about all of the jobs that are impacted by the real estate industry not transacting as much. So that leads right into the next piece of data we're going to look at, which was the housing starts, and we got stuff regarding permits. So what we've seen with permits is that permits were seasonally adjusted annual rate of 1.39 million. This is 2% below the revised April rate of 1.42 and 1% below the May of 2024 rate of 1.407. Now, what we've seen with permits is that they're more future looking. Think about it. Like, all right, I want to build this house in the future. I'm going to have to like start preparing that process. I got to go down to the city, get my permits and stuff. So permits are forward looking. And permits fell 2% from the previous month to a 1.39 million rate. And then with the housing starts, what we've seen is that these housing starts, which is starting to show the complication for builders, right? So builders are mainly the people building homes rather than like your mom and pops out there, right? So with these housing starts, what we're starting to see is that they fell to a 5-year low. Construction of new homes fell 9.8% in May, while these housing starts fell to a 1.26 million annual pace, down from the 1.39 million previously. Builders are starting to pull back and show that this buyer demand is expected to be weaker. And if you're expecting weaker demand, you're not gonna like go load the boat and start like, let me get a ton of wood, let me get a ton of brick, let me go buy all of this land and not be able to sell these homes when I start. So that's really what's reflecting in these building permits, and housing starts starting to come in a little bit soft. And what many builders are doing with existing inventory is they're slashing prices, doing these price reductions, and they're having to do these rate buy downs just to spark some demand out here. So it's really uncertain with how everything's going. We're going to keep on watching all this data as it comes in. As you said, you're spot on with that. I wish I knew how to share this on the screen and show your... Hold on, let's see if I can do it. I don't know how to do it. One of these days I'll have it ready, but yeah, this is a recipe of stagflation for sure. And that's going to impact all asset prices, right? Not just stocks, not just real estate, and not even just assets. Think about your jobs. And if the job market starts kind of slowing down, an economy where the economy is resilient and dependent, that resilience is dependent on the turnaround and the velocity of money and it being like your dollar being spent. Think about it. When you go pay your electric bill and then the manager gets paid and the manager goes and pays rent and then the bank kind of gets a cut and then taxes get paid. There's just so many different levels to this, and it's a super uncertain time. So we're going to keep on watching this stuff. We're going to keep on watching this conflict in the Middle East. We're going to watch what the Fed says. We're going to watch the labor market. We're going to watch inflation, the impact of tariffs, how these trade deals are going. And y'all, tomorrow is Juneteenth, so the stock market is closed. So I may or may not make a video tomorrow. It just kind of depends on what kind of data we get out and any economic news. You know, that's what I like covering, that I'm a nerd about. But we'll just watch that. I'll for sure be back on Friday, though. You were right about the summer part of labor. Pretty sure I heard Powell say he is waiting for summer data June, July, August, which sets up for that September cut. Yeah, exactly, because they're expecting inflation to be elevated in the summer anyways. Like, they were, well, who knows if it's going to show up because it didn't show up in the previous report, but some are saying just because it didn't show up in the previous report that, all right, well, it's not going to not show up. So just because it didn't show up in the previous report, it's going to show up in that next one. And if not, like July. But I don't know, man. I don't know. You never know because, and some people say the data's rigged. It could just get revised. So we'll just see. We'll keep on watching this. I appreciate you being here watching this with me, learning with me, learning together. I invite you back next time. Hope you're